We're already kissing the first level here at around 39.48. We got as low today as 39.71. That's
Yeah.
going to be a first level of support. Second support and third support follows. And for me, listen, these are tradable levels, these first two. Once we get down to the third support and my max drawdown level, that's really where I start buying for the longer term again. And I think like 8 to 10K is very reasonable in the next 3 to 5 years on gold. Again, I'm not looking at, thousands of percentage gains. I think you have to be realistic in that sense.
If you do the calculation here, gold's still up 52% this year. So you've got to take things into perspective. And there's the old cliche, no pain, no gain. That's what it's all about. And there are very few people who are going to stay the course, hold the fort with their gold and silver. And I think they're going to be highly rewarded for it because none of the fundamentals have changed for gold and silver.
Gold's recent pullback is not the end of its bull run. It's the market catching its breath. Technical levels around $3,948 and $3,500 are shaping up as key areas of support, echoing patterns seen in the late 1970s when similar corrections paved the way for explosive gains ahead. The fundamentals remain firmly intact. Global debt continues to balloon, inflation lingers above target, and central banks are quietly positioning for a long-term shift in monetary power. What we're witnessing isn't weakness, it's consolidation before the next leg higher. Gareth Soloway, a seasoned technical analyst, and macro strategist Mario Innecco highlight that, despite short-term volatility, the broader setup points to much higher gold valuations, potentially $8,000 to $10,000 within the next few years. Silver, too, remains on course for a significant move once it stabilizes near the $40 level, with $60 to $62 projected in the next phase of this cycle. Both metals are responding to the same underlying reality: unsustainable debt, eroding trust in fiat, and a Fed boxed in by inflationary pressures. Patience and perspective are key. These corrections are opportunities, not threats. The next major rally is forming in silence. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Let's look at this chart because it's fascinating when you look at 1979 and mirror that with 2025. And just to take a look at this, we had the same run up early here in 1979. We had the same run up here in 2025. Then we went into this base of consolidation, and then literally 9 straight up weeks in a row in 1979 led to this big correction. And sure enough, 9 straight up weeks, and we're correcting as well. And a lot of people say to me, and this is a valid point, is that, this isn't the same, right? We have a very different scenario. It's true, and we're going to go over that in a second, but I think it's important to recognize that fear and greed are the same, right? And so while in 1970, Volcker was raising interest rates in the 80s, right? He raised it 15, 16, 17, 18%. Here we have the Fed lowering rates. We also had only 32% debt to GDP in 1979, 1980. We have 130% now. And so things are very different, but human psychology doesn't change. Now, how does the difference play out? The difference maker is in 1979, when we topped out, it literally took almost 30 years for gold to make a new all-time high. I think we make a new all-time high within 6 to 12 months, but the correction still needs to happen. I do. And if we go to this other chart on gold, I've laid out my levels already. We're already kissing the first level here at around 39.48. We got as low today as 39.71. That's going to be a first level of support. Second support and third support follows. And for me, listen, these are tradable levels, these first two. Once we get down to the third support and my max drawdown level, that's really where I start buying for the longer term again. And listen, I still have my long-term gold holdings. I want to be clear on that. But for me, I can't pay up here when I see past corrections. One thing I want to show you guys, and this is super cool. So let's go back to the 1979s. Where did gold pull back to when it had its first major bounce, right? And the answer is, if we look at this, look at the high of that push up where we consolidated. And if we draw a trend line there, that's virtually where we pulled back to before we actually got our first major bounce in gold. Well, what does that mean? Well, if we pull back in that same manner in 2025, that would bring us down to about that 3,500 level, which if we flip to this other chart, that's my max drawdown
Right.
level. And so ultimately, while the correction is likely going to be a little bit painful for people that bought at 4,000 or above, I think, again, if you're someone with a longer term view, the differences in the government spending, the debt the US has, debt to GDP, and interest rates, that tells you buy like crazy when it gets down to these levels. Fed, number one, they're going to cut 25 basis points. I think for the most part, they're going to stay somewhat on the more hawkish side, meaning that I still think we're going to get a rate cut in December, potentially January, but we're not going to get that 50 basis point at any of these meetings. The main culprit here is that inflation, to me, is still a little on the higher side. And the question, too, we have to ask ourselves is the CPI data that we just got last week. Number one, it was the only economic data that was reported by the government while it's shut down. And number two, do we actually trust that data? Because again, I liken back to the previous, and this is so interesting. If you go back to the last Fed decision when we had them cut that 25 basis points I think it was in September, it was 6 days before that announcement, we shockingly got this really bad jobless claims number, people filing for unemployment. It shot up from 220,000 to 263,000. And everyone in the media was like, oh my goodness, maybe the Fed needs to cut 50 basis points instead of 25. Lo and behold, they cut 25 and they kept on their path. But then miraculously, 5 days before this economic event of the Fed rate cut, now all of a sudden we get CPI showing much better than expected inflation, 1/10 better across the board on core and regular CPI, also pushing the Fed to do more, to be more dovish. And I would just call a question mark in on this, that it seems very suspect that just before these Fed decisions, the data all of a sudden looks very, very good for rate cuts. I mean, I think overall you have to be thinking 5K is the next big threshold, right? Human nature, psychology, which is a big part of investing and trading, it's always attracted to these bigger numbers. And obviously we got up to about 4,400 or so. Now we're correcting. I think the next push takes out those all-time highs, tags 5,000. I don't even think that's the end of the bull run. I think this could be a multi-year move, but that would be where I would say, okay, once we achieve that, let me just, again, take a pause. Let me analyze the charts. Do we see a pullback at that point before we continue much, much higher? But I think like 8 to 10K is very reasonable in the next 3 to 5 years on gold. Again,
Okay.
I'm not looking at, thousands of percentage gains. I think you have to be realistic in that sense. But where else are we turning? Especially with risk assets. And I think this is so crazy, right? Is that gold has been going to new all-time highs until this latest correction, while the stock market's been going to new all-time highs for months and months and months. Historically, that does not last. And I do
Well,
worry that if the stock market corrects significantly, which I do think is on the horizon,
yes.
more money eventually finds its way into gold. Silver is one of the most remarkable, and this led me to make this call on silver topping out as well, is that it's the beauty of charts again, and I know it almost seems too simple to work, but it does, is that if you take a parallel channel and you just connect it to the low here in '08, so the financial crisis low, and connect it to the low of COVID, and you stretch that parallel up, and so let's just go back to this. So basically all I did was I connected those two lows. You stretch that parallel up to the 2011 high, and look at what it gave us. It literally gave us the top. And this is just the power of charts. And remember, charts are replications of human psychology. And so what it's telling us is that you're likely or probability wise going to get a pullback. And that's exactly what silver has done. Now, the bigger question is, how low does it go? Like, where am I as an investor starting to accumulate? All I'm doing here is basically drawing a trend line through these recent levels. And essentially, I'm looking for a move back to about $40 or so. We get back to $40, which, by the way, a week or two ago was like, that's so far away. And then here we are from 54 back to 40, 46 in just a matter of a week or two. So don't be surprised if we get back down to $40 and you could accumulate all you want there. I still think silver's going to 60 to 62,
60.
Probably early next year.
Okay.
And then beyond that, the sky's the limit. The only trigger here, and this is the only thing that people have to remember about silver, is that it is partially an industrial metal now, more and more, in fact. And so if the economy really here in the U.S. starts to struggle, there will be some downward pressure that the precious metal side of investing in it will have an impact on. And that's the only thing, versus gold is just purely a pure play on the fiat currency issue.
The Dow-to-gold ratio has long served as one of the most reliable indicators of major financial turning points. Every time this ratio collapses below its long-term moving average, it signals the end of an era for financial assets and the beginning of gold's dominance. That moment has arrived again. The last 3 times this occurred, during the Great Depression, the late 1960s, and the early 2000s, gold went on to vastly outperform stocks. Each crossing marked a monetary reset, a rebalancing of trust away from paper wealth and back to tangible value. Now, history is repeating itself. The ratio has again fallen beneath its 7-year moving average, suggesting that the financial system has entered another transition phase. Record global debt, persistent inflation, and a fading faith in fiat currencies amplify gold's strategic importance. The ratio could drop below 1 this time, meaning that a single ounce of gold could buy an entire Dow Jones share. This shift isn't just technical, it's psychological and systemic. Gold is once again becoming the ultimate benchmark of real value amid paper market fragility. The clock is ticking on the next phase of monetary transformation. Let's get back to the interview.
Basically, the Dow-gold ratio is how many ounces of gold you need to buy 1 Dow Jones Industrial Average. And it goes back to the early 1900s here. I've got it back to around 1917, even though you can go further back. So the 3 tops that we've had, the 3 major tops we've had in the last 100 years, those are the tops in the stock market relative to the gold price. Of course, prior to 1933 in the US, gold, the dollar was as good as gold, so it was the top in the Dow. It wasn't really the Dow gold ratio; it was just the top in the Dow. And this is per ounce, of course. So, yeah, at the time, 1 troy ounce of gold was $20.67, and that ratio was just above 20. So yeah, the Dow almost reached 400. And then we saw the crash of 29, and then the bear market that bottomed in 1932-33. There's like a double bottom, and that ratio actually got down to around 2. So you only needed 2 ounces of gold to buy 1 Dow. The Dow dropped like 90% during the Great Depression. And the black line that you see, I've added this on. This is a new thing here. And actually, I have to thank Charles Gav. He's an older gentleman who's French, but he's like a market analyst, fund manager. And I watched one of his videos, and he uses this 7-year moving average with the Dow gold ratio, and I thought it was really interesting. And you can see that the Dow gold ratio is only crossed below that 7-year moving average, while up until recently it had only crossed below it 3 times in history, and all those 3 times that crossing below it, a kind of death cross for financial assets, had only happened 3 times, back in the 30s, and back in the 60s, and back in the early 2000s. And every time that happened, there was some kind of reset, or the precious metals, especially gold, outperformed the general stock market. It was the time to be in gold, or heavily weighted in gold versus the stock market. What does the Dow gold ratio mean when it reaches the bottom, like it did in 32, 33, 1980, and to some extent in 2011? Well, it means that it's safe again to go into the financial or the general stock market or financial assets. and that you don't need to hold gold. And actually that was true in 2011. And why did this ratio not keep going down in 2011? Well, I think it's because the central bankers did something they hadn't done before, and that was massive money printing. So they bought some time. They kicked the can down the road up until recently. But now you see that for the fourth time in about 100 years, we've crossed back below that 7-year moving average. And I think that's really pointing to a major outperformance by gold in the coming years. And I think the reset will be complete when we reach at least 1, but we could go below 1, which would mean you need less than an ounce of gold to buy 1 Dow Jones Industrial Average. And when that happens, I think it means it will be safe to get back into the stock market. Yes, I would never get rid of all my gold, but you can use some of your gold to invest in financial assets. It will be safe. Right now, just like Morgan Stanley a month or so ago said that their 60-40 portfolio is now 60-20-20, that they're taking 20% off their bond holdings towards gold. And gold used to be 0, right? 60-40 was just stocks and bonds. I think that it should be 60-20-20 now, with gold being 60. And I'm not joking here. This is serious. This is what the Dow gold ratio is telling us, that we should be at a 60-20-20 gold, bonds, and stocks. That's if you want to diversify. Some people might say, well, I'll just go 100% into gold. Why hold stocks? Well, and bonds. Well, some people might need dividends or income from bonds, a coupon. So I can see why they'd want a 60-20-20 portfolio. So now I want to talk a little bit about the gold price and the silver price, what they've been doing in the last week. Yeah, it's been a bit topsy-turvy, to say the least. Prior to a week ago, everything was plain sailing. Gold was almost at 4,400. Silver was back above 50 for like the first time in 45 years. And now it's turned a little bit. We're down about 10% in gold, and silver it's more. And a lot of you might be a bit concerned, and I've gone through this before, ever since 2002 when I started buying gold. I've seen many of these moves, and yes, they are kind of gut-wrenching, but don't forget, and I've got my calculator here, gold started the year at 2,600, so right now, Rudy and I got up quite early today. It's not even 6 a.m., but London time, but gold is at 39.62. So if you do the calculation here, gold's still up 52% this year. So you've got to take things into perspective. And there's the old cliche, no pain, no gain. That's what it's all about. And there are very few people who are going to stay the course, hold the fort with their gold and silver. And I think they're going to be highly rewarded for it, because none of the fundamentals have changed for gold and silver. None of the geopolitical factors have changed. So, yeah, I'm not concerned. I've become immune to this. Of course, it's kind of gut-wrenching, as I said, sitting through it. But 2-3 months ago, gold and silver were a lot lower than they're now. Beginning of the year, they were massively lower, and here we are. And there's a lot of hate that I see from the Bitcoin crowd, from the mainstream crowd. So gold is now hated not just by the bankers and mainstream economists and almost everyone, but also the people that were supposed to be proponents of sound money, of small government and decentralization, right? The people who are into Bitcoin. So to me, that's a sign that we're nowhere near where gold is going in terms of providing purchasing power. I don't even like to say the price anymore because that's not really what it's about, right?
Every major market cycle tells the same story. Greed peaks, fear returns, and gold quietly reclaims its throne. The Dow-to-gold ratio now confirms what few dare to admit. The era of paper wealth supremacy is ending. This shift isn't about short-term price swings, but about the revaluation of tangible assets versus inflated promises. History shows that when this ratio breaks down, it marks a generational opportunity for those holding gold, not stocks. As debt, deficits, and distrust spiral higher, the smart money is already rotating into tangible value. The next few years will likely redefine what haven truly means. When the dust settles, gold will not just be an asset, it will be the benchmark against which all others are measured. Those who endure the volatility will be standing on the right side of history. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.